Welcome back, everyone, to another EUVC episode. As you know, this is one of our special pitch episodes where we spotlight the fund managers who are truly moving European venture forward. Today, we're going inside a firm that's been doing data-driven VC long before it became a meme. Redstone is a European specialist investor built as a dual company from day one, a family of focused funds on one side and a software and data platform on the other. That's so exciting. They've quietly compounded a model that avoids hype cycles, sticks to fundamentals, and delivers consistent performance across every fund, all with zero public money and a reputation earned through work, not noise.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
From first time to seasoned investors, the EUVC syndicate is not just about capital. Get involved, co-lead deals, share insights, bring in great people, and help shape the pipeline with us. Visit eu.vc/syndicate to learn more.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Welcome to the podcast, Michael.
Thank you very much, Andreas.
So did I do some justice to you with that intro?
I think that was a very nice intro. Thank you very much for that.
Amazing, brother. Okay, Michael, let's pull up your deck. Let's talk through Redstone.
If you remember one line today, make it this one investment, over 200 ventures. That's European VC simplified. And that's what we've built with Redstone, with the Redstone Global Venture LTIF. It's a first of its kind way to access venture capital in Europe. I'm Michael, AGP and co-founder at Redstone. We're a VC platform with already now over 600 million euros in assets under management, a team of over 35 people across Berlin, Munich, Zurich, and Helsinki. And we run a family of specialized funds from 10, 20 million up to 100, 200 million each fund, each with its own investment committee and a dedicated sector fund focus and dedicated industry LPs.
Let me just ask you, you've got a very significant number on the screen here, which is 3.2x DPI on average. Let's unpack that number because first and foremost, I commend you for putting it here and letting everyone in the world know. I think that we would all be better off if we were a bit more open about our performance numbers. And then this is, of course, a significant number, so I get why you are. So let's talk about that.
The first funds have been performing very well. We were able to return a significant amount of money to our LPs, which they are very happy. And I think also why this is possible, because as we run smaller funds, not one very large fund, it's something that's easier achievable. For example, in one of our first funds, there was a company called Athenian Partners, which was a kind of intelligence and knowledge brokerage and expert network company that we sold at over 10x. And so that was quite good. And we've been doing this now for over like 12 years, basically starting from day one with a vision, with a kind of what you also said, dual company. We'll come to that later, and are doing this now across Europe every day, week after week, month after month. And that has given us truly also this kind of, I think, top quartile outcomes by really doing this one thing very well, having specialized teams with evidence-based driven investing. Also, what's I think important in this is that Redstone is really built on three pillars that we think set us apart. First one, it's right-sized and specialized funds that change the outcomes. For example, we have a fintech fund with 20 banks as LPs. We have a health fund with the largest operators and owners of hospitals and nursing homes as LPs. So we build these specialized funds. The second one, we're very data-driven by design. And what's interesting about Redstone is basically, first we build a tech company and then the investment firm on top of it. And it's not just that we use data, like everybody's doing this now, but we have a complete operating model where basically we map down hundreds of process steps, drilled them down and unpacked them, and then thought with software, how can you either automate them or make them more efficient? And it's not that we want the software to do the investments, but really rather kind of helping the people to be more efficient and better with their decisions So spending time on things that really matter and that make a difference, being able to spend time with the founders, being able to, when you have all the information there, then think and discuss about, does this sector make sense? Does this company make sense? And then ultimately, we're a strong believer in Europe, and we think that Europe really drives returns for many reasons. We have top technical talent. We're very capital efficient. I mean, everybody says exits in the US, for example, are bigger or higher value. That's true. But if you invest at a 20 billion valuation and exit at a 200 billion valuation and maybe some dilution in between, you'll have a 6x. So if you invest at a 10 million valuation and exit at a 100 million valuation, some dilution in between, you'll have the same kind of multiple in between. But that's more likely in Europe. So we're a big fan of that, and also I think data backs that. So that's the core of Redstone. And if you then also look not only on a kind of TVPI, DPI number, but also on a IRR number, all the funds are doing really great. No fund has lost money so far that we have managed, something we're very, very happy with. And most of them, or nearly all of them, trail in the top quarter in their respective area. So I think that's like a good path to be. And obviously they still are continuing. If you look at fintech too, maybe the only one that's still in the single digit, you will wonder, but there are companies like XAI in there, Finanzguru, who's an amazing insurtech company. So very also positive on that one. Now coming to Sophia, which is really one of the core parts of what we do, of the dual company we have built. We use it really across everything we do, from like fund and strategy design to sourcing support. We do a lot of data-driven sourcing. But then obviously also we get deal flow from like university spinouts. Maybe one or the other knows we're publishing Europe's largest university startup report. We have our sector teams, and now obviously also we get a lot of references into the firm. And then the question is, how do you organize all that? How do you benchmark that? We're tracking millions of companies, founders, also other investors. And the thing is, it's not just that the data is there, but really every company gets a school grade. So it's easy to compare companies within individual sectors and areas, one to another. And then we rank them. We have the taxonomy. We obviously use it heavily for due diligence, and we track startups over time. And that truly gives you early access to relevant founders as an LP. It's no random deals. We're very conviction driven. I think that's really special about Redstone, and I've never worked in such a place before where people try to form such a strong own opinion, really beyond the hype. We clearly prioritize where to invest. It's very measurable and kind of very structured. Our aim was not to build like basically a one-hit wonder, but something that's repeatable in a way how we operate, and very systematic.
Michael, just tell me a bit about, I'm sorry for calling you out to be the boogeyman here, but you've been doing the data-driven VC model, so to say, for a long time, whereas it's something that's kind of grown over the last 3 years, and now everyone is claiming it. Could you talk a bit about where you're seeing VCs maybe overselling this side, and like be super clear on how are you different from others when it comes to this?
I would say there are two main differences. One is obviously now a lot more data is available than in the past. The question, and that's also why we built Sophia, is how do you put this into relation? So having about it within a sector, information about 100 different firms is one thing, but then having like 100 different KPIs or data points, and then creating one kind of school grade out of it for each company, and then make it comparable and say, okay, the team quality, like we have, for example, a scorecard for every founder. Like, how do these scorecards compare? That's still quite difficult, and you need to put quite some work into it. That's one thing. The other thing is then really building an operating model out of it. I mean, we have a complete software stack. We have a complete operating model where everybody knows in which stage, who does, or what needs to happen to evaluate a company. And that's also something that we see, that even if companies have a lot of the data, maybe they're not yet used so much to a very structured operating model that would give them an even larger advantage. And I think we have really ingrained that over the past 12 years. And just one example, because we, like every also investment, every due diligence is broken down in dozens of different steps. If there is, let's say, a super competitive deal, and we say, okay, we just have, let's say, a week or maybe just a few days, we can say, okay, we now pull everybody together for 3 days. Everybody in the firm, 30 people, work on this one deal. So suddenly you get like 90 working days of due diligence within 3 days. And that's possible because we have all these different process steps and all the different kind of pieces. And then we say, like, we allocate basically within minutes, like every task to different people. And that way can operate very, very efficiently. And I haven't seen that at another firm so far.
Maybe let me take this chance to double click a bit, because one of the things I always say when I look as an LP at fund managers is always, it's one thing that they say they have an edge in something specific, but when you then drill further in, you realize that there's a little bit of a lack of an ecosystem here, or a lack of processes and system design that truly plugs into each other, so that their motion, so to say, is compounding every single day they go to work and the team goes to work, that they get better at what they do, and the engine becomes stronger and the flywheel around the firm becomes stronger. And this is why I wanted to double click with you, because it's one of the things that you've been really working on for 12 years. And I think this is where it stands out from the average VC that's now starting to do much more data-driven investing than they have in the past, because it's such a big difference whether it's a bolt-on or it's something that you're designing specifically for right from the beginning. And I'd love to also make another point, which is also that you and Samuel, your co-founder in Redstone, are company builders. You're not just investors, you're also building a company here, which I think is, I honestly think that unless you're a boutique specialist investor that never wants to scale, is how you need to go about venture, because otherwise you just basically are no better than the talent you're able to bring on board. And by natural evolution, the best people tend to spin out and do their own thing at some point. And for that reason, unless you can really supply an infrastructure that's incredible and allow people to do something that they cannot do from outside of the system. And this is one of the things that I really think makes a standout blue chip fund that can scale, stand out from all the others. So I'm really happy that we dived a bit into this. Maybe you can talk a bit about the firm aspiration, the company building aspiration of you and Samuel.
Yeah, so absolutely. I mean, with Samuel and myself, we've both are founders. We've both founded and built very data heavy companies. The largest one, for example, that I built originally with Rebate Networks, which was more an e-commerce type company, but scaled to 30 countries, close to 10,000 employees. So I think we really bring this entrepreneurial spirit, and obviously we wanted to build. The approach we have taken, building these sector specific funds, is super hard, because you have to raise for different funds with specialized LP bases again and again. But it's like building a very, let's say, long-term oriented company, where we said, once you kind of hit product market fit, you have really a scalable company. And we took that approach, and we say, we know it's much harder, it will take longer than if we just build one larger fund after the other. But it ultimately will give us a scalable kind of platform that we can then operate. And it's a little bit like, if you compare it, for example, let's say a production company, depending on what tech stack you have, the software alone, just because you have like a kind of factory with SAP operating software in it, it doesn't make you a great kind of factory. But the question is, what's your operating model? How are you using it? And then kind of good from great will differentiate. And we try to build a scalable great company and knew that that was tough and would take a long time. But now we have these kind of very clear focuses of the funds. We have an LP basis in each fund that, at least to a large extent, that supports the ecosystem. And then we have this broad platform that kind of feeds and supports all the different strategies and that supports. And also, I mean, with that strategy, you also can give a lot more responsibility and I would say a lot more exciting work to individual kind of team members, because within their strategy, they get a lot more responsibility they would normally get, which is also great to hire and retain amazing talent, which is obviously core.
I know Samuel is a big fan of A16Z and what they've been able to build. And I kind of liken it to that in the sense that A16Z is a model built around sector-specific funds and standout fund managers of each of those. And I think it's definitely one of the right ways to be building a firm.
Absolutely. I mean, it's a great firm and a lot to learn from. As we are about investment, maybe one example, how we operate as a firm now. Think like summer 21, the absolute hype of consumer companies. And we looked at the data and everything and said, okay, how can we avoid this hype and how can we invest with conviction where it really matters? And then we found, for example, and said, okay, if the AI was starting to rise, and one of the themes was cybersecurity around the new AI world. So how do you protect the AI chips from being hacked and attacked? And then we invested in Nexane as one of the first institutional investors when nobody else was looking, and avoided a lot of the consumer companies, which is one of the reasons why, for example, some of the funds from 21 are like some of the best performing funds in our portfolio, which is very contrary to some other in the industry where obviously it was a bad idea to invest in 21. And that's what I mean with, we'd always try to have a strong own conviction, no matter if we lead, if we co-lead, if we follow, we always go into something if we're really convinced. Going to the individual strategies and talking about then, so how does that translate into the LTIF? We, as many times mentioned, we build specialized funds, something like deep tech or fintech and enterprise tech, health tech, education, and many more. Now we're actually starting also a blue fund, which is ocean tech with some of world's largest shipbuilders as LPs. And now all of these funds, it would be a lot of work, you would need a lot of people if you would want to allocate to all of them, to a lot of tracking. And the LTIF allocates to all of them across all of the funds that we're launching. So your starting exposure basically includes a lot of our flagship strategies with live deal flow, diversified by sector, stage, geography, vintage, and that all with one allocation. So one transfer, one investment will give you that. And below that, you have many different expert teams, each with its own pipeline and post-investment playbook. We also do a lot of that. We always have a 100-day plan after we invested, what should be achieved, what are the next milestones, etc. So we're thinking long-term, but not yet 100-year long-term. So maybe to kind of also summarize that, what is the Redstone Global Venture LTIF really? It's if you want to summarize it, professional venture made practical. It's an evergreen, distributing, semi-liquid structure that rolls capital forward and delivers a really broad diversification. For example, statistics show that for a really great risk-return profile in venture, you need exposure to at least 200 ventures or 10 venture funds. And we provide this with one transaction. I think one of the biggest misunderstandings of people investing in venture is that they underestimate the size of portfolio you need. And that's very different to many other asset classes. In venture, you need a disproportional larger portfolio than in many other asset classes. So when you enter there, you should really think about, how do I get a broad diversification. And we offer very simple access here. You can subscribe it with one transaction, so no capital calls, no complex paperwork, no extra KYC. Also, super simple. And the best thing is you can think of it like a fund of fund without the costs of a fund of fund. So, for example, there's no carry in the LTIF, so no double dip, and just depending on the amount, a small kind of infrastructure cost and a small management cost, but which we really pass through. So we're not earning that, but because we're earning money with the underlying funds, and also because the money is controlled, we can manage the kind of capital a lot more efficient. One of the topics that a lot of LPs also tell us with individual funds, they say it's great the IRRs you're showing, but I cannot have the money in another fund producing the same IRR. So I have to keep actually a significant part in maybe a money account, which is much lower. So the true IRR for all the venture funds is lower. And because we pack that here into one LTIF, and we know and operate the underlying funds, we can manage that capital a lot more efficient, and also can be that way can create better returns. It also, now you will ask probably like, okay, how do we get the money back? Obviously, everybody's interested in that. It's designed to continuously return and distribute. So it's an evergreen, but a distributing evergreen. That means the profits are distributed. Our target is that, because also part is invested in a venture debt, but broadly diversified venture debt strategies, to at least return from the second year onwards, independent of exits or not, the kind of inflation rate between 2 and 3%. And then after 8 years, it's possible to redeem the money, so the principal investment plus accrued value, and then on a yearly basis. So that after 8 years, you basically have a truly semi-liquid, yearly liquid product, where if you want to invest somewhere else, if you want to do some rebalancing in your portfolio, that gives you a lot of flexibility. And it's essentially venture from a professional VC with a proven track record, made very practical to invest.
When investors come into the LTIF, will the LTIF then allocate into each of the other funds, or will the LTIF be co-investing with the other funds? Just out of curiosity and for people to understand exactly what the dynamic is.
Absolutely, good question. So the LTIF will allocate as an LP and will become an LP in all the different funds. So it is like indirectly, you're basically an LP in all the different funds.
Awesome. Beautiful. Michael, thank you so much for coming on the podcast today to talk a bit about Redstone. You have been around forever, so in that way you can say, well, why are you guys bringing Redstone on to do a pitch episode to tell the world about yourselves? But honestly, not enough people know about you because you're not the loudest guys in the room. And I thank you so much for just having been focused on building and investing in the ecosystem, because you've done an incredible job. And I hope that everyone who didn't know you already now do so, because we did this episode together.
Andreas, thank you very much for these kind words and for having me on the show and having Redstone on the show.
From first time to seasoned investors, the EUVC syndicate is not just about capital. Get involved, co-lead deals, share insights, bring in great people, and help shape the pipeline with us. Visit eu.vc/syndicate to learn more.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.